Our final speaker this afternoon brings with him a unique perspective on our economy, our larger industry, and specifically workers' compensation. As a current educator, former director of economic research here at NCCI, and the former president of the Insurance Information Institute, Bob Hartwig's range of experience and insight are particularly valuable in times of change. Bob has a lot to say about our economy's outlook and, of course, the impact of COVID-19 and what it means for workers' compensation. Joining us from his home in South Carolina, here is Dr. Robert Hartwig.
Thank you, Mark, and thank you everyone for joining us at AIS 2020, the virtual edition. To say that we're living in unprecedented times and that there are unprecedented challenges facing the workers' compensation line is a refrain we've actually heard before at prior AIS gatherings. That was certainly the case after 9/11. And it was certainly also the case during the Great Recession more than a decade ago. But through each and every one of those events, the workers' compensation line has persevered. Now, it's my great pleasure today to be able to bring to you a detailed analysis of the economic impacts of the COVID-19 pandemic, the challenge of our day on the workers' compensation line and on the property casualty insurance industry.
I'm going to provide you with an outline of my presentation where we are going to be discussing a variety of issues impacting property casualty insurers, but of course focusing on the impacts of coronavirus, COVID-19, and the impacts on the P&C insurance market and the workers' compensation insurance industry. Now, we're going to begin with a brief overview of the P&C insurance industry overall and take a look at its financial performance. And we'll see that the industry has entered the COVID-19 pandemic period from a position of financial strength, and that's a great thing. We'll talk about COVID-19's potential impacts on key lines. We'll talk also about the extraordinary volatility we've seen in investment markets so far this year, much of that also due to COVID-19 and the pandemic. And then, of course, the economy and the labor markets, which are extremely important to workers' compensation, the labor markets in particular, and some federal and state initiatives that are also important to commercial insurers and workers' comp insurers in particular. And then we'll summarize with a few conclusions at the end. Now, when we think about the P&C insurance industry, we all know that it's a very strong, stable, sound, and secure business, whether we're talking about being able to pay catastrophic losses from natural disasters. This is certainly another sort of disaster, one we have not really seen in the history of the industry. And what we could see is that we ended 2019 with a record $858 billion in policyholder surplus. There was a lot of volatility in the markets during the first quarter, so we've dropped down to an estimated $775 billion, but the industry is still very strong, stable, sound, and secure, and prepared to pay whatever claims are necessary associated with policies that have been purchased by policyholders. And I'm making that distinction because there are some issues in terms of some types of entities making claims on the industry's surplus for coverages which simply don't exist. Now, we'll talk about that later on. Now, the industry had finally restored itself to a similar level of profits and profitability as it had seen prior to the financial crisis. However, certainly we expect net income after tax, in other words, the industry's profits, to fall as a result of the COVID-19 pandemic for a variety of reasons that we'll discuss soon. Now, the question is, how much might it fall? Obviously, we've entered a recession, and it's typically the case, if we examine history, that we see a drop-off of about 4.5 points in terms of the industry's ROE following major economic declines. During the last economic decline in the financial crisis, the industry's return on equity, ROE, fell by about 8 points. And we can see historically by examining economic downturns over the past half century, again, as I mentioned, the approximate decline in ROE is about 4.5%. The median is about 5%. And we would certainly expect that this time around. Now, the bigger question for many is what is going to be the impact on premium growth? With the economic slowdown, there's certainly going to be a substantial impact. Pre-COVID, the outlook for 2020 was for overall net written premium growth of 3.8% across the industry. Now it is very much a question mark where we will wind up in 2020. I am attempting to look at history here to see if there are any answers, just as I did with the ROE, but history doesn't really provide much in the way of answers in terms of what might happen to premium growth after economic downturns. As it turns out, we've seen periods in which there was growth and where there was decline in terms of premium changes on an annual basis in the P&C insurance industry. So on average, after economic declines, during and after economic declines, we've seen essentially no change. So history doesn't tell us anything. However, we do know that this event, the COVID-19 pandemic, has created an economic tsunami that has erased huge amounts of exposure from the industry. It's dramatically slowed down the economy overall, and as a result, I am certainly expecting to see a decline in growth in terms of all lines P&C, and of course personal and commercial lines as well. And I expect commercial lines to be more severely hit. These are very, very rough ballpark estimates. We have many months left to go in the year. Much can happen, and much depends on the pace of recovery from the pandemic and the pace at which states reopen. And if I do take a look at some evidence that we do have, some initial analyses that have been done for a few key lines from a recent Willis Towers Watson analysis, for example, they have estimated that workers' compensation could potentially see 12.5% to 25% reduction in premium written. Again, a wide range, and it depends on the pace of the recovery and the depth of the recession itself. And you can see the declines in several other key lines, and these are multi-billion-dollar declines for the most part. So there will be a substantial impact on the overall property casualty insurance industry growth rate this year. I still expect it to be slightly positive, but it is possible it could move into negative territory. From an underwriting perspective, the industry was actually in a relatively sound position. As you already heard from Donna, the combined ratio last year overall was 99. That's pretty good. And of course, this year, it's very difficult to say where we will wind up. We've yet to move through hurricane season, wildfire season. And again, of course, we do not know the ultimate effects of the COVID-19. If you do again look at the limited analyses that are available here, the two areas where there's likely to be the most significant impacts are again workers' compensation and also business interruption and contingency, which means such things as event cancellation. And of course, focusing just on the U.S. business, where we could see is workers' comp, the losses are potentially the largest. However, for the most likely scenarios, the optimistic and moderate scenarios in terms of the severity of the pandemic, we see the larger losses in the area of business interruption. So it's only in the most severe scenarios where the pandemic essentially rages on virtually uncontrolled for an extended period of time where workers' compensation would see the more pronounced losses. But there are many ways to think about what might happen to workers' compensation. One would be to look at the expectation of what would happen, say, in the transportation sector. Many workers' comp injuries are associated with truck drivers and other individuals who drive for a living. The expectation is that even under the optimistic scenario, we'd see commercial auto claim frequency fall by about 12%, and in the moderate scenario by about 23%, and fully by a third in the pessimistic scenario. This means there are likely to be fewer workers' comp injuries originating from these particular occupational classes. And it also depends not only on what we expect for an annual basis, it depends on the pace of the recovery once again. So again, this is commercial auto claim frequency, and we could see under the optimistic scenario by year-end 2020, there's virtually no change in commercial auto claim frequency. So the effects are essentially transient, and that would be true for workers' compensation claims originating from this sector. On the other hand, in even the moderate and the pessimistic scenarios, there are lasting effects, and we would expect to see continued downward pressure on workers' comp claim frequency coming from this sector well into 2021. Now, I had mentioned earlier that it's been an extraordinarily volatile year on Wall Street. That volatility is going to increase. So what does that mean for P&C insurers? Well, again, the industry had restored itself to reasonable levels of investment income, actually getting back and exceeding its pre-crisis levels for the first time in 2018 and 2019. The COVID pandemic is going to put a damper on that. Reason why that is going to happen is because the Federal Reserve, in order to keep the economy afloat, it has radically reduced interest rates, essentially short-term interest rates back down to zero, just as it did during the financial crisis. So even as the yield on the P&C insurance industry's invested assets began to come back up in 2018, it's begun to come back down again. And that downward trend in interest rates is very, very visible. If we look at both short and longer term yields, here we could see a dramatic drop off in interest rates in the last several months. And again, we would expect those interest rates to remain depressed. There's also been a lot of volatility on Wall Street. In 2019, the S&P was up about 29%, but at one point during the height of the volatility associated with the COVID concerns, the market was down by about a third. So it's made a pretty extraordinary recovery, and April 2020, in fact, was the largest monthly gain in the S&P since 1987. It's up about 30% from its March 23rd trough. So the question is, has the market gotten ahead of itself, given that GDP growth in the second quarter is expected to shrink by 22% and the unemployment rate is going to exceed 15%? We, not that long ago, just in March, saw the largest drop ever in the Dow Jones Industrial Average of over 2,000 points, or about 8%. So truly extraordinary volatility we have seen very, very recently. And it's not over. It's going to continue. So the markets do seem to be anticipating more of a V-shaped recovery, perhaps more stimulus, an expedited vaccine, or some combination of all of those. So to summarize what's been going on recently as companies have been announcing their first quarter 2020 earnings, these are some of the first numbers we actually can assess and review in terms of what insurers themselves think the impact of the COVID-19 pandemic is. Now, mind you, these are just first quarter results, so insurers really don't see too much impact on their books yet, though there's more certainly to come. But we've had more than 20 insurers and reinsurers report, and what we've seen is some very large losses being reported associated with COVID-19, essentially establishing reserves. Many companies have reported they expect their losses to exceed 100 million, 200 million, 250 million, and some companies, particularly larger foreign domiciled companies for whom the U.S. is a large market, close to $500 million. So it's going to be a very large number all told when all companies report in the first quarter, and certainly would expect to see more in the second quarter. Many companies are also reporting realized investment losses from the chaos on Wall Street during the first quarter. However, we would expect some of those to be offset with some improvement in the second quarter, assuming that the markets continue to stabilize. Now, let's talk about the economy. This is really the major issue that's affecting us today in terms of the impact on the P&C insurance industry and workers' compensation. And, unfortunately, the longest business expansion in U.S. history ended in February of this year after 128 months. The good news is that recessions typically only last about 5 to 7 months, and we're expecting about a 22% decline in GDP in the second quarter on top of a nearly 5% decline that we saw in the first quarter of this year, before starting to see the economy recover in the second half. When we look at the GDP report and unpack it a bit, what we see is that consumption, which accounts for about 70% of spending in the U.S. economy, was down nearly 8%. Domestic investment, meaning spending by businesses, was down about 5.5%, and exports and imports by about 9%. Government spending was about flat. So that translates into some terrible numbers. Again, down about 5% in the first quarter, but this is nothing compared to what we see when the second quarter numbers come in. When we look at this, I think it's obvious to many people, but this chart really shows how closely tied GDP growth is, the pace of the growth of the economy on an annual basis, on a quarterly basis, and looking at direct written premium growth in the P&C insurance industry. And you could see they're pretty tightly correlated. And so I'm forecasting out very loosely at this point, but we would expect to see pretty substantial declines in both as we move through the remainder of 2020. Now, obviously, payroll is extremely important to workers' compensation, being the exposure base. You can see payroll proxied here by wage and salary disbursements in the economy, making a fairly steady charge upward ever since the recession. We could see workers' comp trending downward a bit, not so much because of weakness in the economy in 2018 and 2019, but because of the fact that rates have been going down. But what we will see is this curve will bend for wage and salary disbursements, payroll, as the data become available for 2020. So we'll see them both move down in tandem very quickly as the year moves on. Now, what about COVID-19 and its impacts on labor markets? This is really where the rubber meets the road in terms of workers' compensation, and we'll talk about some regulatory issues as well. Now, unfortunately, the tragedy here is that some 33.5 million people have filed for unemployment since mid-March of 2020. So that's extraordinary. This shatters all previous records. This means that 18% of the pre-COVID labor force has filed for unemployment, and we could see that the number of people filing for unemployment on a weekly basis shatters all previous records. Every week since March 21st, we've seen numbers that well exceed the prior records, which were set way back in 1982, as well as during the financial crisis in 2009. The huge surge in initial claims for unemployment has naturally resulted in an enormous increase in the unemployment rate. In April of 2020, we saw the unemployment rate nationally surge to 14.7%. That is the largest number we have seen in many, many, many decades. And we could see, again, just as recently as February, we were at near 50-year lows of 3.5%. So this is really a national tragedy for American workers. And so looking ahead on a quarterly basis, we expect to see about a 15% average unemployment rate for the second quarter before only slowly making its way back down through the remainder of 2020 and through 2021. And in fact, by the end of 2021, we would still expect to see unemployment rate around 6.5%. And from the most recent unemployment report in April, what we could see is that 14.7% unemployment rate, that's the result of about 19.5 million people actually losing their jobs in the private sector alone. There were another million or so who lost it in the government sector. That is a decline in the workforce, of the private workforce, of about 15% in the span of simply 1 month. Again, truly extraordinary. In terms of the job losses, in terms of the Great Recession, we have seen versus the Great Recession, we can see that unemployment insurance claims, as I mentioned, total 33.5 million now, which simply erases all the jobs created since the Great Recession, all 24 million of them. And we could see that this simply dwarfs the number of jobs lost during the Great Recession, which was about 9 million. So what we've seen is far, far more severe. What we can hope for, however, is a swift recovery. There are other labor market impacts that are very important as well when we think about exposure. Not surprisingly, the early data show a reduction in the number of hours worked, and we would expect this to plunge as much as it did during the financial crisis, if not even more. So this obviously reduces exposure because it directly reduces the amount of payroll. The average hourly wage of private workers continues to rise, but we would expect that to be tempered as a result of COVID-19. Although ironically, in the early stages, because so many low-wage workers lost their jobs, it's higher wage workers who are left in the labor force. So ironically, we could actually see a jump in these figures before overall seeing them flatten out a bit for an extended period of time with so much slack in the labor market. Now, so the average change in wages, you could see, was moving up nicely. Pre-COVID, it was up about 3.3% into early 2020, and this was on the back largely of lower wage workers who are making wonderful gains, and for a variety of reasons, including more and more states increasing minimum wages, but also a very tight labor market was helping them see wage growth that they hadn't seen in many, many years. again, this will all slow down. So unfortunately, the number of people who are going to be hired is going to slow dramatically. You can see it already beginning to flatten out at the end of this series. These are the latest data available. They lag behind by a couple of months. So we're going to likely see a 20, 30, 40, 50% drop at least in the number of people who are hired through the remainder of 2020, and it could take a bit longer than that as well. The labor force participation rate is already beginning to drop off. We expect people to essentially drop out of the labor force as a result of economic tough times. We saw that trend accelerate after the Great Recession. It finally stabilized and was beginning to come back a little bit, but labor force participation is likely to drop to some of its lowest levels actually since the 1970s. The number of unemployed persons per job opening had descended to just 0.8 job seekers for each job opening. So it really was a workers' market out there. People could quit and find a job very quickly. This is going to soar as the data come in throughout the remainder of 2020. And just to take a look at the Great Recession, what might be in store. At the height of the Great Recession, there were 7 people seeking a job for every one that was open. So we've come a long way, and unfortunately, this is going to be a huge setback for workers. Now, a couple of other things I want to continue with here and to in fact close with. I want to discuss a couple of important issues related to the regulatory and the legislative environment and some other challenges the industry is facing as a result of these, apart from the economic challenges that I've discussed. And I'm going to focus on business interruption claims as well as workers' compensation. Now, whenever there are major events, we tend to see a lot of regulatory activity, and we are seeing a lot of claims. In fact, insurers have received tens of thousands, if not hundreds of thousands of claims related to COVID-19. Some related to workers' comp, but most are actually related to areas such as business interruption and some with respect to GL. Obviously, things more minor lines like travel insurance, some specialty lines like event cancellation, and also D&O. But each crisis tends to precipitate efforts to stretch contract language beyond the 4 corners of the contract. There are efforts by trial lawyers and others to find coverage where none exists, to find coverage where none was intended, and to find coverage where no premium was paid. This was true after Katrina, for instance. This was true after Sandy, and it is true with the COVID-19. Now, politicians frequently pile on here because there's zero political risk for them to do this. Now, where we've seen most of the press, initially anyway, has been the area of business interruption. This is an area where the industry is very, very concerned. There are efforts here to create coverage where, in fact, none exists at all. Now, as you know, businesses across the country have been shuttered. They've been shuttered largely by government authority. Most business income interruption policies contain language that in order for business interruption claim to be compensable, there has to be some direct physical loss or damage to property, and it has to be the damage has to be caused by or the result of a covered cause of peril. So insurers have insisted that there is no physical loss or damage, that largely it is actions of government or fear of contracting the coronavirus and COVID-19 that has caused many businesses to close. And beyond that, the majority of business interruption policies in the United States do contain a virus exclusion. And despite this fact, some states have tried to override these exclusions, truly extraordinary legislation that would simply ignore the long-standing language that has existed in these policies and that has been approved by regulators in all 50 states. This is a clear violation of the Constitution's contracts clauses, which reads, "No state shall pass any law impairing the obligation of contracts." So I think ultimately the efforts with respect to attempting to get insurers to pay business interruption losses with respect to virus-related issues will fail, not only on constitutional grounds, but on the sheer magnitude of the demand. A nice analysis has been done by the APCIA, which shows that, for instance, for just to pay business interruption losses for small businesses, businesses, those with fewer than 100 employees, the losses could range up to $431 billion a month. If we include businesses up to 500 employees, it's nearly $700 billion a month. Compare that against a total industry surplus of about $800 billion. What this would mean is that the industry would be insolvent within the span of a couple of months. So clearly the demands are outrageous in the sense that these are losses that insurers never intended to pay. They never collected a premium for it. They're clearly excluded, and pandemics are clearly an uninsurable risk. Now, in terms of workers' compensation, there are clearly some pressure points here. Of course, you heard a lot from Donna and from Bill on this issue already. And so I just want to make two final points on this. Now, there's no question here that workers' comp written for COVID-19 exposed risks such as hospitals, first responders, nursing homes will likely see a spike in both severity and frequency. And many states will also require workers' comp insurers to cover the cost of precautionary quarantines. However, a big question is arising with respect to the impact of other so-called essential industries such as grocery stores. And the definition of essential workers varies from state to state. Now, we'll get to that in a moment, but there's no question that outside of the COVID-19 exposed segments, such as healthcare, for instance, some segments of healthcare, we would expect to see a large, swift drop in payroll exposures. Again, we're talking about tens of millions of people who have lost their jobs. There's no way that this can go other than to see a very substantial decline in payroll exposure. And as we heard already, that could be between 12 to 25%, depending on the severity and the duration of the pandemic. Wage growth, as I mentioned, is also going to slow. So AIS 2021 is going to be a truly extraordinary meeting as well, because we're going to have all these results before us to see what the impacts of these unprecedented events are. Some analyses that have been done on this indicate that certain sectors are going to be more impacted than others. When we take a look at the potential annualized premium impact, okay, so keep in mind these are annualized figures. We don't expect the pandemic to last an entire year, but these figures nevertheless represent what would happen on an annualized basis. For instance, we would expect to see as much as nearly 60% of the premium lost from hotel, motel, and food services, about 28% lost from retail, about a quarter lost in professional and technical. And you can go on down the line here. Some highly skilled areas such as information, we don't see much in the way of change, but we're talking about extraordinary losses in terms of premium from various segments of the economy. Now, some other concerns, and really this is the final concern, is going to be the issue associated with the expansion of the presumption of COVID-19, the disease being contracted in the workplace. So we've seen a couple of states expand presumption beyond frontline workers, such as healthcare workers and first responders. We've seen this in Kentucky, which extended it to daycare, grocery store, and postal workers. In mid-April, we saw Illinois extend it to a very long list of workers that you can see here. This was challenged by a number of associations, not insurers, but small business associations in Illinois, and ultimately a judge issued a restraining order, and the Workers' Comp Commission in Illinois did withdraw its rule. However, it's believed that the governor is going to try to pressure the commission into instituting a new similar standard. And very recently, we saw California just on May 6th, where Governor Newsom signed an order essentially allowing all employees across California to apply for workers' comp if they contract the coronavirus with an automatic presumption that it was work-related. This is truly extraordinary. This is going to be backdated all the way to March 19th and is going to remain in effect all the way out into the early part of the summer. And what the WCRIB in California has estimated is that the cost of this could range from $2.2 to $33.6 billion on an annual basis. Just the midpoint of their analysis, $11 billion, is equal to 60% of total pre-COVID California workers' compensation costs. So truly extraordinary. This is one of the major concerns that workers' compensation insurers have today, is the expansion of the presumption of having contracted COVID-19. So let me summarize. The industry is strong, stable, sound, and secure. It was that way before it entered COVID-19, the pandemic. It is that way today, and it will emerge strong as well. The rapid slowdown in the economy, however, is going to be especially painful for economically sensitive lines, especially workers' compensation, which is quite likely to be the hardest hit of the major lines because of its exposure to payroll risk. Asset price volatility is going to continue, and low interest rates are going to be with us for years to come. And so at the end of the day, the COVID-19 exposures are very substantial indeed, and in many ways unprecedented. Yet this industry is an industry that always perseveres, and these risks are manageable. Clearly, however, there's going to be headline risk, particularly on the business interruption and workers' compensation presumption issue.
Well, there you have it. That's my whirlwind tour through the impacts of the COVID-19 pandemic on the workers' compensation line and throughout the property casualty insurance industry. Once again, to say that the impacts are extraordinary and unprecedented is an understatement. We have a lot that we've yet to learn from this pandemic, but we certainly have lessons that we're going to hold for the future. So let me turn it back to Mark and thank you once again, everyone, for joining AIS 2020.